All right, let's go ahead and get started. For those of you who I don't know, my name is Brock Jolly. I'm one of the founders of Veritas Financial. And as we dive headfirst into 2025, excited to give you what has become sort of an annual tax update. And this is an interesting one because most of you have been paying attention to the news here recently. We have a new administration coming into the White House. Don't shoot the messenger, whether you love that or hate that. I didn't make the decision all by myself. But I will tell you that the thing that we're seeing sort of left and right is that there is going to be some significant change. Now, what's really interesting is when Clint and I and our team were putting together today's webinar, we were going to focus pretty heavily on the Tax Cuts and Jobs Act, which is set to expire this year. Well, interestingly, the guy who is sort of credited with putting that together somehow, some way landed back in the White House. So we'll see what happens. Clint's going to talk about that more, but certainly some interesting things to talk about. And the whole idea here, I will tell you that really, really good financial planning occurs when you can couple your investments, your risk management, your taxes, your legal planning. So everything is organized, coordinated, and integrated. And so we've got a long history of working with Clint and the team at RKN. As a matter of fact, we actually worked with RKN prior to Clint. And so have a good track record with the organization, and lots of our clients have used them over the years. So excited to bring Clint here for our update today. Just a little bit of housekeeping. We're going to be about 60 minutes. The target is to do about 40 minutes of Clint talking through some ideas and some strategies. We're going to try to make that a little bit more interactive, so it's not just Clint talking at us. Not that that wouldn't be totally riveting, but we'll have it be a little bit of a conversation. And then we'll open it up for some questions at the end. If you do have questions, please feel free to put them in the chat. Try to use the chat as opposed to the Q&A section, just because, and we may have even disabled the Q&A. Just use the chat, and that way everybody can see it. I would just ask you, please try to keep it pretty high level. We don't want to dive into, here's my specific situation. Neither Clint nor I can really answer those questions because we probably don't have enough detail. So if it's a high level question, please do go ahead and ask that. I know I can speak for myself. I think I can speak for Clint too. Always more than happy to jump on a phone call or a Zoom after today's presentation just to dive into the specifics of your situation and get your question answered as well. This webinar is being recorded. So after today, we'll post this probably on LinkedIn and Facebook and YouTube and whatever other social media channels we happen to have. So you can review it there over and over and over again so you don't miss anything. So with that, really excited to bring Clint here today. Like I said, we've been working with the team at RKN for a number of years. And I would just say, Clint, as both a trusted professional and a very good friend, they just do a great job. And the whole team at RKN, I think when I think about my own personal planning and I think about the folks to whom we refer our clients, right? That's sort of this sacred challenge of, hey, I've got this great relationship with a client and I'm handing them to another trusted professional saying, hey, don't screw this up. And please take great care of our clients and maintain the relationship. The team at RKN has always done an awesome job with that. Just thinking proactively about how they can take great care of clients. And so Clint does a great job. You can see there on the screen, in addition to being a CPA, he's a valuation expert, works with a lot of business owners, and just does a really great job. So with that, I will turn it over to Clint, and I will go in the background, and please feel free to ask questions as we go in the chat. So Clint, the stage is yours.
Well, Brock, I appreciate the opportunity to be here today. I know we've done these once or twice before, I believe, and it's just a privilege to do these together once in a while and keep everybody updated on what's going on. And like you said, we worked together many years and love taking care of clients together. And I think you guys there at Veritas do a wonderful job doing that, and hope that continues in the future. So today, boy, 2025, it's going to be an interesting year, but 2026 will be even more interesting. And so the goal of this webinar, the next hour or so, will be to talk about all things tax, some things budget, and hopefully we'll have a little bit of fun along the way. A lot of information thrown at you. I'll try to leave some time for questions at the end, but there's some things that in particular are going to happen at the end of this year unless somebody does something. And there's already things that are in current law that have changed this year that I've also updated you on in some of the upcoming slides that you probably should know about. And hopefully you'll gain some other new information along the way. So my goal here is primarily with the Tax Cuts and Jobs Act of 17. That seems so long ago now. I want to cover what that was. I want to cover what it did back then, and cover what could happen at the end of this year if it sunsets or goes away. And Congress is already looking at different things to, consider extending all or parts of it, or how we handle this in the budget. And there's all sorts of ideas floating around right now that I'll be going through, different ways to pay for this. And then we'll go through some updates and more. So, but the Tax Cuts and Jobs Act was the most sweeping tax reform since the 86 Tax Act. And so you think, those of you who were around back in the 86 Tax Act, how big that was, and all the sweeping changes that did back when Reagan was in the second term. This was even bigger, in my opinion. So many new things came along with the Tax Cuts and Jobs Act of 17 that, in my opinion, have been very beneficial for the most part. There's been other things I hate, and we'll cover some of that. But there's been for a lot of small business benefits, I think, to the Tax Cuts and Jobs Act. So we'll cover some of that. But overall, back then, it had about a $1 to $2 trillion impact on the national debt that they projected over the first 10-year period. And of course, it was from the beginning designed to sunset at the end of 25. So this is a very pivotal year. And with the new administration, they're already trying to figure out what to do with this thing. But before we begin, I thought I would start out with just remembering how it used to be. We were kids, we were playing Monopoly. Wouldn't it be nice to go back and just play Monopoly again and only owe $200 in tax? Now, I'll admit, when I was, a kid, I don't know how old I was when I first started playing Monopoly. Yes, it is my favorite game. To me, $200 was a quite regressive tax policy for me. I feel like $200 was a lot of money based on the money that I typically had in front of me. All I wanted to do was buy Boardwalk and Park Place. I didn't really care about St. James Place or some of the other ones on the board. I just wanted to be the wealthy landowner, the baron. And for me to be forced to pay $200 in tax was outrageous. I did not write my congressman back then, but it was, to me, just incredibly regressive that I had to pay $200 no matter what, even if I made no money that year. So anyway, no one promised the tax code to be fair. The U.S. has a progressive tax policy, obviously, and what I thought I would do is off the bat show you some stats from the 22 data book that the IRS puts out. And this is the information from the Tax Foundation. I just thought this was interesting before we jump into the meat of the presentation. But high income taxpayers paid the highest average income tax rates. So you think about, you hear this all the time in the news, are wealthy people paying their fair share? Well, according to this, the top 1% have an average tax rate of 26%. The top 5%, their average rate is 18.8. You can see how it goes down to the bottom 50% of taxpayers. Their average tax rate is only 3.7%. So just, that's good to see, I think. I think it's good that if you make more money, you pay more tax. The question is when does it become regressive versus progressive? And so I just thought that was interesting to kind of look at that as far as what the average income tax rate is across different sectors. And along with that, another piece of data here I found interesting. I'm kind of a tax geek. I love numbers and charts and so forth. So again, when you break out the number of returns from, I believe, the 22 year, there were 153 million returns filed that year. Out of the top 1% of those returns, 1.5 million returns filed Average tax rate, 26%. You can see in millions there, 3.3 billion in adjusted gross income collectively. And what I just found interesting was if you look in the middle there where I boxed it, the top 10% of taxpayers actually make up almost half of the overall adjusted gross income across our country. And those top 10% pay 72% of the overall income tax. So again, it's not just the wealthy paying tax, right? It's the middle class, it's the upper middle class, it's the in certainly people that are earning 50,000 and up, right? So if you look all the way to the right, the bottom 50% of taxpayers again are only paying 3% of the tax. Average tax rate 3.74%. So take it for what it's worth. Our tax policy is what it is. It's designed to help those who don't make as much not have to pay the same as those who make a lot more. So that's some interesting data. I thought maybe would be a good place to start. So the Tax Cut and Jobs Act of 17, TCJA. What it did, if you can recall back 7 years ago or so, it lowered our individual tax rates. That's the first thing everybody noticed. The top rate went from 39.6 on the federal side down to a top rate of 37. A lot of the brackets changed as well. So, the top bracket now is, the taxable income for 37% starts around, I guess, 607,000. I don't have the exact number in front of me. So everybody liked that. In fact, some people got burnt by that. Their withholding changed as well. The withholding tables at work changed. So they all of a sudden had more take-home pay, but then when they filed their return, they got surprised with realizing that because they had more take-home pay, less withholding, then they actually owed a little bit of money. So in the end, we all had to adjust our W-4s at work or our estimated tax payments. It lowered the corporate tax rate. So you may recall the corporate tax rate back then before TCJA was 35% top rate. And TCJA lowered it down to a flat 21%. And so that incentivized some tax structuring work to maybe convert to a C Corp for certain companies in the right fact pattern. It increased the standard deduction. Last year's standard deduction was 27,000 or so. This year it's around 29 or so. For 25, actually, it'll be 30,000 roughly. So it basically put a lot more people who were on the verge of between standard and itemizing. That basically, because the standard deduction increased so much, it allowed more people to take the standard deduction and benefit from that. Believe it or not, it overall did not change too much as far as how our work was performed. We still, had just as many returns, just as much complexity. Some people ask me sometimes, hey, if we ever went to a flat tax, would you be out of business? And I'm absolutely not. There's still tons of planning and tons of things to think about because tax policy is always designed to engineer people's behavior. And so there would always be something on that pendulum that would require some kind of a need for tax planning or assistance, in my opinion.
And I think if I may,
yeah.
Clint, I think that's really the key is proactive and strategic planning. The reality is, you talk about 153 million taxpayers or tax returns. I would submit to you that probably 90% of those people don't do very much in the way of proactive or strategic planning.
Mm-hmm.
And there's an old adage that talks about the tax avoidance versus tax evasion, right? Let's be really clear. We're not trying to evade taxes. We're trying to avoid or minimize taxes legally, morally, and ethically. And that's really what the key here is just understanding the situation and working with a great professional who understands the tax code and how that applies to your situation. That I think is just critical. And most people don't do that on their own. So
that's a great point because at RKN, we're actually focused so much on the planning side. We don't want the tax return filing process to be a surprise. If we've done our job in planning, it should be a non-event. And so we want to proactively throughout the year help our clients plan and really think through how to maximize the tax code to their advantage without crossing the line, but take advantage of every opportunity that's out there. So that's a great point. TCJA also increased the lifetime estate gift tax exemption. So this is not an income tax component, but it definitely, as you probably know, vastly increased the lifetime giving and lifetime estate tax exemption up to, I believe, initially started out, it doubled it. Now it's almost 14 million per person. And we'll talk about some of the changes to that that are coming if nothing is changed by Congress. But it definitely impacted estate planning and gift planning, and made the use of certain types of bypass trusts and credit shelter trusts, and portability arrangements not as needed perhaps in some cases. But with that decreasing back down after this year, it definitely is going to involve a lot more estate planning. So that could impact a lot of people who are in that category of needing planning for estate and gift work. And if, on this slide, the last thing is it provided a new business deduction. I called it QBI, the Qualified Business Income Deduction. I love the QBI. It's another deduction, kind of like depreciation and amortization, where you don't have to spend a dime to get it. For most people, especially if you're under 400,000 of income or so, small business owners, it actually provides roughly 20% deduction without having to spend any money to get it. So think about an extra 20% off on your net income as a deduction that you don't have to actually spend a dollar to get. So it benefited our clients here at RKN greatly for the most part. There are provisions here and things that are gotchas and things to consider for certain types of businesses, but this QBI deduction really, really helped a lot of business owners. All right. What it also did was it suspended miscellaneous itemized deductions. So this is a bad thing. So it took away the ability to, if you don't have a business, you can no longer, under current law, write off your CPA fees or your financial planning fees directly. If you have a business, we run a lot of that through our companies now under current law. But it suspended those 2% miscellaneous itemized deductions, unreimbursed job expenses, all the kind of stuff you used to put at the bottom of Schedule A when you itemize. Currently, a lot of those got suspended, so that hurt a lot of people. It also limited the state and local tax deductions. So this is that dreaded $10,000 state and local tax limitation that we all hate on the West Coast and East Coast. So many of you are impacted by this. So it limits you to that 10,000 per year. That's why you may have heard of a lot of states now coming online with bypassing the SALT limitation. By allowing different tax regimes to pay, for example, pay your state estimates through your company if you're a business owner, through arrangements called PTET, the pass-through entity tax election, like we have here in Virginia and Maryland and other states. I think 13 to 15 states or more now have that regime. But it definitely limited it, and it hurt a lot of people who are in wealthier areas. It limited the home mortgage interest deduction, you may recall. So it capped it now at 750,000 loan balance, and if you're above that, then basically there's a proration and so forth. So that was also hurtful to people who have high loan balances, wealthier taxpayers. It suspended personal exemptions, so you may recall those went away, and we'll cover that a little bit more later. And it increased the AMT exemption amount. So the AMT, the alternative minimum tax, as you may recall, is the flat tax. It is the alternative flat tax that's always running on the side, even if you don't realize it, that based on your income deduction and fact patterns for that tax year, it's always calculating a flat tax that if the flat tax is higher than your regular tax, then you owe AMT. So, but there's a certain AMT exemption that it increased to help people avoid the AMT hit. And so that's the flat 28% flat tax that is a gotcha. At least it was before TCJA for many people. And worst of all, golf became non-deductible. Brock, I don't know about you. This is probably the most unfair provision of the Tax Cut and Jobs Act, in my opinion. Greater than SALT, the SALT limitation. As a golfer, I believe, and probably many of our people on the webinar today, there's so much business that gets done on the golf course. How in the world would Trump, of all people, want to make golf dues non-deductible? I don't understand it. It just
Fair
doesn't
point.
seem.
It's a fair point. And I'm looking at some of the folks who are on here. I think there's some disappointment by that as well. So
It defies logic. I don't know. So I couldn't tell if the guy on the right with the plaid pants is Bill Murray from Caddyshack. I couldn't tell, but then we had to include Phil Mickelson, my favorite golfer. So hopefully that changes. All right, let's talk about some of the provisions that could be changing this year. And so let's start with the big picture. So if all provisions get extended, there's a lot of people who are projecting that the cost of that could be as much as 4 to almost 4.5 trillion per year, which would add to the now $36 trillion federal debt. So that's the problem. Obviously, we don't want to increase the national debt. You know, it's obviously increasing every year. We have a deficit. It's increasing the debt. And where does this end? And so, you know, depending on who's in Congress, you know, there's appetite, you know, more or less, you know, trying to figure out how do we balance the budget, how do we avoid adding more to the debt, and so forth. So that's a big problem if all provisions were extended. The question really becomes how do you pay for it? And so we'll cover that in subsequent slides. But if provisions as they are now were extended for right now, and allowed not to expire or sunset at the end of 25, some CBO estimates, some U.S. Treasury, the Office of Tax Analysis estimates report that average U.S. households would see a 2.2% lower tax bill. And depending on what happens to that QBI business deduction that I talked about, that 20% deduction, the $4.2 trillion estimate could rise to as high as $5.5 trillion, depending on what happens to other certain provisions like QBI, corporate tax rates, interest expense limitations, that kind of thing. So that's important to consider. The CBO does admit that, you know, there's certain aspects of extending the TCJA would be pro-growth that would be offset by other measures. But there's pros and cons here. There's difference of opinion, let's say. It depends on who you listen to. I know the Cato Institute put out a good chart on some of the major tax changes in 26 compared to what they are now, if you want to look that up. But we don't believe that there will be substantive tax policy change in 25. We believe that Congress will probably make it prospectively starting 1/1/26. But there are some tax planning moves to think about then if that occurs. So 25 is going to be an interesting tax planning year because as we get further into the year, I believe there's only about 149 legislative days on the calendar. So they actually don't have tons of time to implement all the changes that need to be made to allow taxpayers to really plan for 25, do some income reduction shifting versus 26. And so we'll see how this all develops. And that's why we wanted to do this webinar earlier this year so you can start thinking about it. And certainly if you're a client of RKN, we'll be looking at this with you throughout the year. So what happened? So number one, individual tax rate. If that provision sunsets, will revert back up to the 39.6 rate. The key difference here is that it won't stay at the high, you know, 600,000 or so taxable income for married filing joint, or actually this year will be 751. It'll actually revert back to a lower number. So not only a higher rate, but a lower threshold on the income, on the brackets. So that would be pretty punitive then. So more and more people will get sucked into a higher tax rate at a lower income threshold. So that's something that to consider. The standard deduction would revert to roughly half of the current level. So instead of the high, if you're married filing joint this year, 30,000 or so this year, it would revert back to almost half. So more and more people, you know, we'd have to look at, you know, they might be harmed by that. They, you know, depending on how much you give, what your medical expenses are, depending on what happens with the mortgage interest limitation and so forth. That would be sometimes punitive, sometimes beneficial, depending on your fact pattern, but that would go down. The SALT limitation would go away. So many people will be cheering that. They wouldn't have that $10,000 limitation on their state and local taxes on the itemized deductions. So, you know, they would be able to report the full amount of their state and local taxes on their Schedule A itemized deductions. So that would be a big win for many in this area. And frankly, that would be a way to pay for some of this. If there is talk of actually both making SALT go away permanently, like actually denying all those deductions. And on the other side, there's also talk of other changes and things that we could do to tweak it. So I'll be covering on the later slides some of the wins in Congress that impact SALT. The mortgage interest deduction, if it's allowed to sunset, would revert back to the $1 million liability, home indebtedness threshold on acquisition debt. and 100,000 on home equity debt. All those old rules that were in effect prior to 2018. Now the $750,000 limitation and the denial of home equity loan interest would go away, and it would revert back to the old rules. Miscellaneous itemized deductions, those 2% of income deductions on Schedule A would come back. The child tax credit would revert from the current $2,000 back to $1,000 per child. Personal exemptions would return, approximately $5,300 per taxpayer and qualified dependent. The AMT exemption would revert to pre-TCJA levels. This is a problem, in my opinion. I don't know if you remember, Brock, there were so many taxpayers back before 2018 that were getting hit more and more with AMT, and it was causing a lot of consternation, and Congress basically realized we got to do something about this. And I believe there was even an AMT fix that was like a patch that was done prior to TCJA. And so if they don't do something with AMT this year, it's going to revert back to pre-TCJA levels, and it's going to harm a lot of taxpayers and probably cause a lot more people to be in the AMT this year or for 26. And then finally, the QBI, the qualified business income deduction, would go away. And so that would increase most small business owners' tax liabilities, and I believe would not be pro-business. So it's something to think about. And then the big one here is, like we mentioned before, the state and gift lifetime exemption would go back to $5 million per person. From right now, it's about almost 14 million. It would be indexed for inflation. So some estimates have that pegged around 7 to 7.5 million per person, in effect as of 1/1/26. There are some planning tips though. And not being an attorney, I just wanted to at least throw them out. You might need an estate planning attorney to help you with this. There are things like slats and grats, ways to get assets out of your estate while still retaining the right to income distributions, gifting options to the next generation, or generation skipping transfers and that kind of thing. Not my expertise directly, but I certainly know of them, and certainly can advise on the income tax component of that. Ways to make sure you're taking advantage of portability if one spouse dies, and that definitely helps to pass assets to the spouse and use up both lifetime exemptions properly. I think planning on this estate and gift thing is going to be imperative this year if you haven't already done it.
Clint, just yesterday I participated in a similar webinar. I was a participant on it rather than a host, but one of the big topics was about this exactly. And this was hosted by one of our life insurance company partners. And I mean, they're so focused on that for that exact reason. And, who knows exactly where things will land, but the fact that right now, you can put about $14 million aside, that's a pretty high number. A husband and wife can put aside almost $30 million. That's a big number. But if
Yeah,
this reverts, we're sitting here in Greater Washington, D.C. By the time you own a house and a retirement plan and a few dollars here and there,
yeah,
it's not difficult for many of our clients to be above that $5 million threshold. And if all of a sudden that gets hit with estate tax, I think that is concerning to many of our clients. And so the key is just, again, doing good planning around this so that that money can go to where you would choose, as opposed to Clinton's monopoly analogy of like, IRS income tax liability, you owe $200 or potentially a whole lot more if you get hit with this. So lots of really good planning that can be done around this proactively.
yeah. Even on the tax planning side, I wanted to throw in a slide. Like I said before, income tax planning is going to be even more important as we get closer to year end, trying to determine what the winds of change are at that time, so we can do a little planning around timing of deductions, move things into 25 versus 26 or vice versa, depending on what we think is going to happen with tax rates, the QBI deduction, and a host of other provisions. So reconsidering bracket management, timing of deductions, even considering Roth conversions. I know I have more and more clients who are doing this and dividing up their retirement plans into pre-tax and post-tax options with all the benefits of a Roth IRA. More and more 401k plan documents are coming out with a Roth bucket inside the 401k as well. There's been some good tax changes with the Secure Act 2.0 in that regard, preventing R&Ds on those Roth 401ks as well. But converting to Roths now, perhaps at lower income rates, could be an option, a tax saving move. One of the changes coming to capital gains rates is also important to consider. Right now, capital gains rates, the more favorable capital gains rates, which are 0, 15, and 20%, are pegged to certain income thresholds. Well, if nothing changes, the capital gain rates are going to go back to the pre-TCJA rules, which were pegged to certain brackets. So now they're pegged to certain income thresholds for capital gains, and they may refer back to under if all this sunsets, is they would refer back to your rate for capital gains would depend on what tax bracket you're in, and so that is a bad change in my opinion as well. So, in other words, you would get the 20% bracket. If you went back to the old rules, the 20% capital gains bracket will only apply if you're in the top tax rate. It'd be pegged to whatever bracket you're in instead of a certain income threshold. So change there would occur. Rethinking your business structure. So depending on what happens with the QBI deduction, the 20% deduction for pass-through companies, it might behoove us to look at business structure again. If QBI goes away, there might be a reason to actually convert more and more companies to C Corp. If C Corp rates stay at 21 or even lower, I know Trump wants to lower that to 20 or maybe even lower if possible. So that's something that we always look at as part of our planning at RKN. Other options, harvesting capital losses, education savings accounts, look at your charitable giving. One of the changes two changes that I'll mention real quickly. Right now, you can donate up to 60% of your adjusted gross income. That would revert to 50%. And currently QCDs, those qualifying charitable distributions, have gone up to 108,000 now if you're 70 and a half or older, allowing you to make direct transfers to charity and avoid that coming into income, which would cause certain provisions to phase out perhaps on your tax return based on your fact pattern. But charitable giving is a big deal to look at this year, depending on what they do with TCJA. And I already mentioned that, so I'll keep moving. All right.
Hey, Clint,
Yeah.
If I can pause you for a second, I wanted to kind of catch you before the transition here. So, and I'm going to ask you a question and try to make it as apolitical as possible, which is challenging sometimes. But, the Trump administration has created this Department of Governmental Efficiency. Right. And as an entrepreneur, I'm like, well, hey, that sounds great. I understand that obviously there's a lot of political turmoil that accompanies that. And so, but the point is, as you think about it, if the government somehow, some way becomes more efficient, and those of you who live in Washington, D.C., many of you have probably seen that the government tends to be pretty inefficient at some things. But, you would think, okay, that means we require less to be budgeted to cover expenses, right? We need less revenue as a government. I'm just curious what your thoughts are about how that might impact the overall tax code, what might come of things. I don't know if you've seen any projections of what the Department of Governmental Efficiency is projected to save, and just kind of the trickle down of that on tax brackets and tax planning. Just curious as much as anything.
I don't know how to answer that briefly. There are so many variables that go into that. I will tell you this. I heard Trump say yesterday, the day before, that energy drives everything. And so in his mind, if we can drill, baby, drill, cut energy costs, put tariffs on everything coming in the country, everything works, covers TCJA extensions, it helps America enter the golden age, and it puts more money in everybody's pocket. I don't know. I mean, it depends on which economist you listen to. In my opinion, I think the more efficient our federal government is, the better. There's so many things that go into the federal budget right now. It's $4.9 trillion a year. And one of the things we're going to talk about later that could have an impact on people's pocketbooks, especially for our retirees, is Medicare. They're talking about trying to make some changes to Medicare to help pay for some of this. Um, so it just depends on what they can get through Congress. Not everything can be done through executive order. If it has a budgetary line item impact, then it's got to run through legislative, action. So, and Trump has a slim majority in the House. He's got that 53-47 majority in the Senate. So they're going to have to use budget reconciliation to get through anything they want to do. For the most part, I would assume. Um, and so hopefully in the end, it benefits us all. That's my best nonpartisan answer.
Yeah, so the guarantee is it should be interesting, I suppose. So no, that's great. Thank you.
Yeah. I thought I'd throw in Trump administration wish list. Boy, what a whirlwind the last 4 days have been or so since Monday, right? Um, I think we've heard many things that we never have heard before, which we'll cover in subsequent slides. But Trump would love to eliminate taxes on tips, eliminate taxes on overtime pay, even eliminate taxes on Social Security benefits, which I'd be a fan of. To me, if you're paying in the FICA tax all these years, then you have to be taxed on your benefits as well. That seems unfair. But that's a tax cost to do that. He wants to make the current standard deduction permanent. So, leave it at 30,000 for married filing jointly or so, instead of having it draw back down. He wants to reduce the current corporate tax rate even more. I believe the last rate I saw was 20% instead of 21%. Not a huge change, but it could help. He wants to make the QBI, that qualified business income deduction, permanent, which I'm a fan of. I think that would help a lot of our smaller business clients who are pass-through entities. He wants to restore the research and development deduction. This is a big deal. If you have a company doing hard science work, anything that is experimental in nature that you do, you try to claim the R&D tax credit. The current law is unfavorable in that regard. It requires you to capitalize those costs and write them off over 5 years if they're US based, or over 15 years if they're foreign based R&D expenses. So he wants to restore the R&D deduction period, so you can write off all the R&D expenses in year one. So that would be something favorable to business, especially if he wants to make the US a manufacturing based state or country again, as he's claimed. And we'll talk more about other initiatives that have been rolled out since Monday. He wants to introduce a new tax credit for family caregivers. I think this is interesting. We'll see how the CBO scores that. And he wants to make interest you pay on any loan on US made cars deductible. So obviously that's trying to incentivize people to buy US made vehicles. And hopefully US automakers provide a product that is something that people find they want to buy. Let's see. All right. He also wants to put tariffs on all imported goods. I think I'll come back to that. I think I have a lot to say on that, but let me keep on going. Protect the border and American jobs to increase tax revenue. So in his mind, protect the border, give Americans back their jobs. I think that's a blanket statement. I don't think that's always necessarily exactly how it can be parsed out, but that's the mantra. Hey, he wants to take back the Panama Canal. I had no idea we didn't have it to begin with. I guess he says China runs it now, but he wants to take it back, which I think will be pro American defense and pro trade. I'm not sure how he plans to do that. He wants to plant the U.S. flag on Mars. I thought that was awesome. I felt like I was transplanted back to the early 60s. I wasn't alive back when Kennedy did that. Said we're going to go to the moon, but now we're going to go to Mars. That's interesting. He wants to rename. I guess he already did rename the Gulf of Mexico to the Gulf of America. Just a lot of non-tax type things that he's announced. Something interesting you may have heard of is this new $500 billion investment in something called Stargate. It's an AI initiative. He had some tech giants with him in the Roosevelt room the other day, from OpenAI, Oracle, and I forget the other company, pulling together tons of money to start this AI initiative called Stargate. That they spun it as a way to basically cure cancer and other diseases and develop vaccines within days that are specific to the person based on their specific type of cancer marker in their blood. And you know, if you're dystopian in nature at all, that would frighten you quite a bit. And it would, you know, make you wonder what is the deal with tech giants combining with the federal government, and you know, where's this leading? I don't know, but you know, if they can cure cancer, I'm all for it. Um, Obviously, he's, you know, working to pull out of the Paris Climate Accord, the Organization for Economic Development, the global minimum tax regime, the 15% global minimum tax. He's not a fan of, so he's pulling out of all those types of trade deals and international tax deals, trying to bring America first again and get out of international deals like that that hurt American sovereignty, in his opinion. Drill baby drill, going back to you know, an energy policy that is based on fossil fuels, and revoking the EV mandate that Biden had, and um, 100 plus EOs and counting. So that's where we stand. That's all on the wish list. How's he going to pay for this? I thought I'd throw this in because that's important to talk about, right? So I added up all the savings. I won't talk about the costs of everything. We already know there's tremendous cost to extending TCJA and some of the other provisions that he wants to put on the wish list that are on his list. Um, these are not all going to happen, obviously, but just things being talked about in various committees. I counted up over $730 billion in savings over 10 years. If you count all the things that they are discussing that would change potentially to healthcare, Medicare, and other related programs. Changes to energy programs, over 450 billion in savings over 10 years. Just little tweaks to things here and there. It's 50 pages of changes. That's why I didn't try to put them on the slides. Changes to the tax policy. If they got everything that they're talking about, it would be $7 trillion in savings over 10 years. So, you know, that obviously far exceeds the $4 trillion cost of extending TCJA. Changes to trade policy would provide over 2 trillion in savings. So they're thinking about how to pay for this. They're not just trying to increase the federal budget. It's just a matter of, you know, what actually gets enacted, and you know, the you know, you never get everything you want, obviously. Some things also that could change on the tax policy side. So out of that $7 trillion savings that they're looking at, they're not all good, but they're changes that they're talking about that are already being thrown out there. Repeal of green energy tax credits, and perhaps ending the employee retention credit, requiring Social Security numbers for child tax credits. I thought we were already doing that, but I guess you can actually get a child tax credit without a Social Security number if the child's a certain age, below a certain age. Increasing the tax rate on endowment funds, repealing the SALT deduction entirely, which would save $1 trillion. I don't like that. I mean, I can't deduct my real estate tax or my state income tax anymore. I don't like that. Maybe eliminating the business SALT deduction, eliminating or lowering the home mortgage interest deduction. Well, that would not be good for housing, you know, but that's something being thrown around out there. Eliminating nonprofit status for hospitals. Again, these are all ideas being floated to bring in more revenue and pay for the cost of some of the wish list items and extending TCJA. Eliminating the exclusion of interest on muni bonds. That's not good. Ending tax preferences on other types of bonds, corporate bonds, and so forth. Eliminating head of household filing status. Eliminating the American Opportunity Education Credit, the Lifetime Learning Credit. Maybe even replacing HSAs, the health savings accounts, with a Roth-style universal savings account indexed for inflation. So there's a lot to be thrown out here. I'll cover one more slide, then I want to go back to tariffs. Eliminating charitable contributions to health organizations, eliminating the credit for child and dependent care. Well, that's not good for families, but that's being thrown around. Eliminating exclusion of scholarship and fellowship income, the student loan interest deduction. There's even a new border adjustment tax, which honestly, I don't even know. This almost sounds like a value added tax or something, where it's a new tax on goods that based on where they're consumed, not where they're produced. It shifts from an origin-based tax to a destination-based tax, and I have no idea how that would get implemented in our current tax regime. And there's even one idea thrown around lately of one of the congressmen just thinking about, hey, what if we just limit deductions to a certain percentage of income? Okay, so We'll see how that plays out. Of course, the tax code itself is like it's a beast, right? It keeps growing. Seems like over the last 60 years or so, that are a lot of special interest things that get put in there and different things through Congress over the years, and so that's why it's ballooned to what it is. But I want to go back real quick to tariffs. So the biggest way that is being proposed that a lot of this is paid for is through tariffs. Tariffs, I'm not sure if you know this, only bring in about 100 billion a year right now. It's only 2% of the federal budget. The federal budget's about 4.9 trillion right now. Tariffs only bring in 100 billion, roughly 2%. Even if they raise tariffs on all goods coming in, all imports, 10% tariff, it would only provide about 350 to 400 billion in income, um, roughly 8% of the federal budget. Um, Even if Trump got his most extreme proposal through, a 20% universal tariff on all goods, and I read he wants to put a 60% tariff on China's exports, that would raise 3.8 trillion over the next 10 years, just shy of the 4 trillion plus cost of extending TCJA. So there's many people that are on both sides of the aisle on this tariff thing. A lot of people say it's a sin tax. It changes consumer behavior. Consumers will just buy differently. Importers will just pass the cost along to consumers. It'll raise prices. It's inflationary, and so forth. So it kind of again depends on which organization or economist you listen to know if tariffs are the answer to paying for a lot of this. And I guess the answer is we'll see. So. Places this is being discussed, all these changes I just highlighted, various committees, Ways and Means, Energy and Commerce, Agriculture, Education and Workforce, Financial Services. There's all sorts of committees looking at all the different changes I highlighted with trade, energy, tax policy, healthcare, and so forth around Congress. So now I thought I'd shift with the time we have remaining, just covering quickly some of the changes that are already in place. I probably don't have time to cover a lot of these in great detail. I want to leave a little bit of time for questions if needed or discussion. But just so you know, there's currently now a new reporting threshold. There's been a lot of debate about PayPal and Venmo and Square. The threshold to get transfers reported on the 1099K is 5,000 this year. It's going down to 2,500. I'm sorry, 5,000 last year. It's 2,500 going into for the 25 reports that will be sent out by early 26. Sorry for the confusion on that. So the threshold keeps coming down, and the number of transactions keeps going down. So just more and more, they're trying to close the tax gap and figure out these payments in these secondary transfer apps like PayPal, Venmo, and things that they're trying to basically figure out if those are taxable transactions or not. And so more and more, some of those will be reported, and we'll have to deal with that appropriately on the tax return. But I was telling Brock earlier, there's also some digital basis reporting requirements coming for brokers. They're trying again on digital currency. They're trying to track down not just sales proceeds, but now for next year, also going to be requiring brokers to report the basis of those digital assets that are being transferred, which right now under current law, those are all capital transactions. They're considered under Section 1221 capital assets. So that's good. You get capital gain or loss rules on transfers of those digital currencies, but they're trying to implement more reporting requirements, so it's not so much the wild west going forward. Something that is particularly helpful is a new item that was just rolled out maybe a week or two ago. There's new disaster relief provisions going back to 21. So all the people that have suffered from hurricanes and now wildfires in California, all the devastation in North Carolina, going up through Georgia, North Carolina, Tennessee, if that area was designated a federal disaster area, they're allowing taxpayers to go back and amend prior year returns if needed, or basically bypass the casualty loss rules. Anything beyond a $500 loss will be something you can report, even if you did not itemize, and you don't have to worry about the 10% of income rule. So this is really, really helpful to people who have been so devastated by the natural disasters. Other 25 updates, the tax brackets got a little bit wider So that's helpful if you're in a certain bracket. You know, you don't want to be bumped up like from the 24% bracket up to 32 with this 8-point jump. That 24% bracket got a little bit wider for you this year. AMT exemption is a little higher, so that helps you avoid AMT this year. The standard deduction, like I said, is a little bit higher, up to 30,000 for joint. I won't get into all the details here, but starting this year, if you know anything about the Secure Act 2.0 and the 10-year rule for payouts on these inherited IRAs, starting this year in 25, there's more onerous on starting RMDs if you had an inherited IRA from someone who had already started the required minimum distributions when they died. That inherited IRA has to be cleaned out within 10 years. And so now they're looking at seeing if there's an RMD coming out of that inherited IRA. Whereas before 25, there was a little more forgiveness. If you're age 60 to 63 this year, you have enhanced catch-up ability. So, you know, if you're in that category and you want to throw even more money into your retirement accounts, you know, for example, like on the simple IRA, instead of the $3,500 catch-up for most people, if you're over 50, if you're age 60 to 63, you can actually do 150% of that number. So up to 5,250 as a catch-up instead of a $3,500 catch-up. That's just the simple. 401k contributions went up to 23.5 this year. Catch up is still 7,500, but if you're 60 to 63, you can stash up to 11 grand or so in there beyond the normal 23.5 statutory figure. Increased QCD limits. That's, you know, now you can give up to 108,000 if you're 70 and a half directly from your IRA into the charity to avoid taking that money into income. Increased flex spending limits up to 3,300 now. Kiddie tax threshold, it went up a little bit. Kiddie tax, so if your child, your dependent, let's say, has any unearned income, the first 1,350 is tax free. The next 1,350 is taxed at the child's rate, and then any excess over 2,700 is taxed at the parent's rate. So just know that that's gone up a little bit better, a little bit more if you have a child under 19 or a full-time college student having unearned income. The adoption credit's gone up to 17,280. And again, the lifetime estate and gift exemptions up to almost 14 million. And the gift tax exclusion is now up to 19,000. So you can gift a person up to 19,000 per recipient without having to file the Form 709 gift tax form to report to the IRS what you did. Let's see, almost running out of time. One thing on here I wanted to highlight, Social Security wage base. This is the hidden tax. So Social Security wage base is now up to $176,100. It increased $7,500 over last year. So this is that 6.2% Social Security tax that you pay through your wages. And so more and more people will see that Social Security tax 6.2% be deducted from their paychecks for longer if you make now below 176. And of course, the Medicare tax component of that is still unlimited, that additional 1.45% Medicare tax, that's all still in place. But Social Security wage base keeps going up. That's how they continue to fund Social Security. And we'll see what reform comes down the pike in that area as well, now that the new Congress and administration is in place. Slightly higher nanny tax threshold. Now, if you pay a nanny or household employee at least $2,800, you have to report that on Schedule H and provide a W-2 and make sure that's being done. And then finally, the QBI deduction. This year, the married for joint filers, if you make up to $394,600, there's no limitation. Beyond that figure, for joint filers, there can be limitations based on wages, and there can be limitations based on what type of industry you're in. It'll either phase out or it'll cut off. So just know that, and that's an important item for tax planning. Standard mileage rates have gone up to 70 cents a mile. That's good. And bonus depreciation on assets. So if you're a business owner and you're putting equipment in place, just know that the bonus depreciation provisions are decreasing. They're actually starting to phase out more and more. So for 25, I believe it's now down to 40%. Last year was 60%. 179 immediate expensing on assets is up to 1.25 million, so that's good. Um, so depending on what state you're in, some states conform to federal changes on this, some states don't. So talk with your tax advisor on that. And that's all the information. Brock, I thought I would end up with some funnies. Is that okay?
I'm good with that.
I
We
feel
need
like
some levity to, I mean, this is kind of depressing, some of it. So let's
it's
have a little
scary, isn't
fun.
it? So for those of you who are in the dating scene, I'm not, but if you are, and you're obviously this time of year, you're trying to think of every deduction possible. I thought this was pretty apropos. No, sorry, Kelly, taking someone out on a pity date does not qualify as a charitable contribution. So if you happen to be in that place where you're trying to take somebody out just as a favor, you feel sorry for them, you cannot claim that as a charitable contribution on Schedule A. And then lastly, sorry, sir, even if your dog does do his business in your basement, you still cannot deduct it as office space. So sorry, it has to be used regularly and exclusively for the business, and the dog does not count. So with that, if you have any questions, I'll be happy to take them if I can. Put my email, my phone number on here. Be happy to take any calls or emails directly. And again, I think the slides are going to be posted on the various channels that hopefully will be announced if you registered. And I'll certainly happy to email PDF copies to anyone who requests them if you want to send me a quick email. But thanks for the opportunity to go through all this. I know it was like drinking from a fire hose, but hopefully it was beneficial.
That was great. Thank you, Clint. Lot of important and very nuanced changes, and I think that just speaks to the importance of working with somebody who is paying attention to this all day long. You know, I've got clients who come to us or prospective clients, and you know maybe they use TurboTax or something similar to that. And it's just, you know, my observation is just you miss out on a lot of opportunities that you could be taking advantage of. And so, you know, not a commercial. I've seen it a lot. So, all right, everyone. Well, I see we're at the top of the hour. If you do have questions, please feel free to reach out to me, to Clint. Clint's got his information on the screen. Mine's pretty easy. Mine is, I'll just give it in case any folks would like to reach out to me. My email is simply first initial last name, bjolly@vfwealth.com. And the direct phone number to my office is 703-424-2401. So again, Clint, thank you very much. Really appreciate your expertise and guidance and friendship. So
Thanks,
look
Brock.
forward to doing more of these. And thanks, everybody. Appreciate your trust and confidence in us, and definitely look forward to speaking with everyone soon. Thanks, everybody.
Bye.